Today, taking our economic pulse. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. And today, I want to go through the latest RBA Chart Pack and outline some of the key messages that I think are contained inside this pack, which is more than 30 pages of quite detailed charts. Now, this pack was released just a few days ago, and it gives quite a good summary of the current state of play. Now, I should explain that I have picked out some of the key charts because it would be impossible to go through all of them in a reasonable amount of time. So let's start with GDP growth, which is coming off the boil, as this chart shows. And we know that the Eurozone and China and Australia are also experiencing lower GDP growth. Now, if you look at China, the key point to make is that in China, GDP is continuing to slide, but is still in reasonable shape. Now, if you look at inflation in advanced economies, this is another issue. Despite all the efforts of central banks around the world, inflation is very, very low. Now, this, to my mind, is directly connected to the ultra-low interest rates that we have in play at the moment, plus the fact that wages growth is very low. Unemployment in the major economies also look to be improving insofar that more people are in work. Now, of course, you can debate whether this number is true insofar that being unemployed is actually defined more narrowly than it used to be in most Western countries. And as a result of that, the true level of unemployment is probably considerably higher than that reported. And this chart also shows you that in some places, wages growth does appear to be rising slightly, even if it's from a relatively low level. Turning to China, the indicators there suggest that things are continuing to slow with industrial production sliding, the real retail sales down, although up perhaps a little from its lows, and fixed asset investment also easing, together with the Manufacturing Purchase Managers Index. And in addition, the residential property indicators out of China shows that inventory is rising, investment in property is rising, and property prices are going to rise. But again, this doesn't look particularly wonderful. Now let's look at Australia. GDP growth is on the decline. And if you look at the trends over the recent period, there's been some ups and downs, but the overall trajectory is clearly lower. And the RBA has, as a result, downgraded its forward GDP expectations. Now, looking at the contributions to Australian GDP, that contributed by consumption is falling away. Mining investment has dropped into negative territory. And the main growth engine for GDP, as well as exports, is the public sector. And that will include investments in public infrastructure. In other words, government spending is supporting GDP growth significantly more than some other factors. And we can look at mining and non-mining activity, and we can see that the mining segment, from an investment perspective, is weakening, and that the non-mining sector is hardly moving up at all. And if you look across the states, you can see that most of the states are seeing a decline in final demand. And of course, WA has had a very significant fall from the mining boom post-2010. Now, the Consumer Price Inflation Index continues to be low. It's below the target that the RBA sets. And underlying inflation is below the 2 to 3% target. In other words, the RBA has not really done its job, if its job is to maintain inflation in the 2 to 3% band. And of course, this is a problem that many central banks around the world are currently facing. And if you look at tradable and non-tradable inflation, essentially it's the trade-related inflation, which seems to be particularly low. Now, turning to household income and consumption, we see the same olds insofar that whilst the savings ratio is low and perhaps going sideways now, consumption and disposable income are both falling. And that is simply the mathematics of people having less money to spend, and as a result of having less money to spend, they are consuming less. So this is going to be a continuing drag on the economy, in my view. And consumer sentiment continues to be down. This is an average of the ANZ Roy Morgan and Westpac Melbourne Institute consumer sentiment measure, and it shows a continued fall. Also, private dwelling investment is now off its peaks, as shown by the latest ABS figures. And building approvals for the residential sector are also significantly down, and that's true predominantly of high-density housing, which of course includes units and apartments, but also detached housing is also down a bit too. Now, this is the key slide in a way, because it shows that on one hand household debt continues to rise, but housing prices are now sliding significantly from their highs. And this is putting significant pressure on households. And as a result of that, household wealth is declining. We can see there that net wealth is down, wealth relating to dwellings is down, and financial assets are not correcting as much. We have had significant growth in stock prices since the start of the year. It's also worth noting that liabilities continues to rise. Now, in more detail, we see that house prices are falling across all the indices, whether that's CoreLogic, Residex, APM or ABS. So there's no argument about the fact that prices are significantly down. And of course the question is, how far down will they go? Housing loan approvals are also down, both owner-occupied and investors. And it's interesting that investor loan approvals dropped first, but now owner-occupied housing loan approvals are also down, and that's one reason why we argue that the credit impulse is easing. But also business investment is down. This is shown as the share of nominal GDP. And so we can have to conclude that the business sector is also concerned about the outlook and is reining in their investment. Now turning to capital expenditure, mining is significantly off. Non-mining is a little higher, but the expectations indicate perhaps a slight fall ahead. And if you look carefully at the components of business investment, machinery and equipment are down a little bit, but buildings are off significantly. And that means that we would expect to see some pressure in the commercial property sector ahead as well. Now, if you look at the investment by industry, you can see that mining has come off significantly. There's been a bit of a rise in other business services, but pretty much all other sectors are somewhat lower. And it's worth noting that other business services includes information, media and telecommunications, rental, hiring and real estate services, professional, scientific and technical services, administrative and support services. All of these are services which support something else like the household sector or industry. So the concern here is that the parts of the industry which are really generating real growth, other than services of course, are not rising at all. Now the NAB Business Confidence Survey also highlights a fall in business conditions, business confidence and utilisation. And in some cases, like business confidence, we are now below the neutral setting. The data relating to business lending by banks shows that small business lending has gone sideways and is now, in fact, sliding down a little, whereas lending to large businesses, the SME categories include businesses that have reported consolidated annual sales of less than $50 million, by the way. Now turning to housing credit growth, the 6-month annualised rate for owner-occupied and investor lending are both lower, with investors being considerably lower than previously, but owner-occupied borrowing clearly still there, but easing. And this is translated into credit growth by sector. We can see that housing growth continues to decline, personal lending is down, business is a little higher, but as I've said earlier on, demand looks to be easing now there as well. Turning to the wage price index, there's been a slight uptick in growth thanks to growth in the public sector and the low wage hurdles that were lifted a few months ago. But for many households in real terms, wages have not risen at all for the last 5 or 6 years. Now, the employment and participation rates look reasonably good. And the underemployment rate and the unemployment rate are both significantly low. But again, we have to argue whether the unemployment rate represents the true position or not. However, job vacancies are rising a little, and advertisements, according to the ANZ Jobs Survey, are falling away. So this may be a leading indicator of a weaker market ahead. Now, what's fascinating about the employment and hours worked chart? It shows that the average hours worked by individuals is falling, but the total hours worked and the total employed hours worked is rising, and this simply reflects the larger number of jobs. But that does not mean that individuals are necessarily getting all the work that they need. Now, this chart shows the share of output across the states. New South Wales continues to lead the way, although slightly lower, and Victoria is there. Queensland's up a little. Western Australia looks to be declining slightly, and South Australia and Tasmania are also falling. And the state unemployment rates do vary across the regions, with New South Wales and Victoria significantly lower than South Australia, Tasmania and Western Australia. Now, if you look at share of output, which includes the gross value added, the scary thing about this is that it's other business services, which is actually the main contributor to total output. In other words, the things that actually create real value are not those relating to building something or manufacturing something or selling something. They are related to a range of services. But my question is, can we really base a whole economy on business services? Because we do need entities to actually take those services. And by the way, a lot of those business services are in the real estate sector or in the service sector to households and communities. And that is also mirrored in the employment growth by industry. So we see that household services growth is significantly higher than everything else, followed by business services. And things like retail trade, construction and manufacturing are significantly lower. So we have an economy in Australia that is fundamentally over-leveraged into the services sector. And my question again is that going to create real growth into the future? Now, turning to the Australian government budget balance, of course the expectation ahead is that they may well bring it into balance, but as we discussed in a recent post, it depends on a whole bunch of assumptions, some of which may or may not be correct. But the state budgets are definitely in difficulty, and in fact the GST numbers ahead look to be significantly lower because household consumption is off. So I think a number of states are going to have issues, plus of course they also have issues with regard to lower stamp duties because the property sector has come off. This chart shows the public construction work done as a percentage of nominal GDP, and it's showing that the engineering construction is down, but the building construction is continuing to rise. So this tells us that a lot of the activity is government-funded construction. So in other words, our economy is being supported by government expenditure in public projects. Now, if you look at non-financial public sector debt, it's reached about 30% of nominal GDP, of which the Australian government has just under 20%. Now, on an international basis, that level of debt is not extreme, but nevertheless, it is concerningly high. Now, one of the things that came out in the budget was the fact that we had benefited from much higher iron ore prices than expected. And this is because Brazil basically had production issues, and so China sourced more product from Australia. And whilst these higher prices are beneficial to our budget overall, the question is, how long will they continue and can they be relied on? Now, the terms of trade are slightly positive. In other words, we're exporting more than we're importing. And you can see there that the resources sector is considerably the largest compared with services and rural and manufacturing. So we are still very reliant on the resource sector, and as I highlighted, the high iron ore prices. And it's worth noting also that China is by far the largest destination for exports, around 30%. In fact, Japan is taking less than previously, the EU less as well. And India is showing a small amount of growth, and it's my view that India could become more important as we go forward. Now, the net foreign liabilities are quite concerning. There's long-term debt, which is significantly higher than previously. Short-term debt has come down and equity has come down. Now, another way to look at the external position is the gross foreign liabilities, which are predominantly in Australian dollars, 3 billion, plus some in foreign currencies. And the gross foreign assets are about 1 billion in terms of Australian dollars. And if you net the one off the other, that shows us that we actually have around 2 billion debt in Australian dollar terms to external parties. It's a very high level of debt. Now, the Australian cash rate continues to be extremely low, and the cash rate in 90-day bill yield is also continuing to come down. It's worth noting that the policy rates in most advanced economies are very low. This is to do with the central bank policies, the quantitative easing, and of course we've known recently that US's attempt to lift rates basically has been derailed. The Fed is now indicating perhaps that the next rate move will be down. The 10-year Australian government bond yield is extremely low, lower than it's almost ever been. And if you look at the 10-year government bond yields, that's true in the US, Germany and Japan. And of course, the US is reflecting the recent change in the Fed and their policy going forward. Now, the spread between the Australian 10-year bond yield and the cash rate is extremely low. And the non-corporate bond yields are also down. And this is important. The differential between the Australian and US 10-year government bond yields is in negative territory, which is quite unusual. Essentially, it means that investors internationally could invest better in the US relative to Australia, which may be one reason why lower interest rates here will perhaps not eventuate so quickly as some are saying. US corporate bond yields are also down now, reflecting the change in the Fed strategy. And the US corporate bond spreads are also down. So it looks to me as though we could be entering another episode of low interest rates and even quantitative easing ahead, which is not good news because that will simply inflate asset prices and lift debt even higher. Now, talking of debt, the variable housing interest rates have moved up a little. The outstanding loans rate, though, is just slightly lower than that, and this is one of those issues where the reference rate has very little connection to the true rates. But again, the Reserve Bank highlights the fact that new loans are considerably lower, and this is the contention between existing and new borrowers. If you are a new borrower, banks will fall over themselves to lend you money at very low rates if you're a low credit risk. But existing owner-occupied investors have higher loans, and they're generating more returns to banks. And unless you're proactive and try and switch to a new loan, you won't get those new rates. But many people find that they are not actually of adequate credit quality now to qualify for those new loans. So they're stuck, they're mortgage prisoners on higher rates. And once again, of course, the Productivity Commission highlighted the fact that the standard variable reference rate is completely meaningless. It has nothing to do with the real world at all. Now, the fixed interest rates on 3-year maturities have pretty much stayed where they are, and the variable housing interest rates are higher for investors, particularly interest only, compared with owner-occupiers. And the business lending rates for small businesses have stuck around their same level, but the rate for large businesses has gone up, and that really reflects some of the repricing thanks to the BBSW rate moves. Share prices have done very well recently. We had a bit of a wobble around the end of last year, but up again. And in fact, the ASX 200 isn't doing too badly compared with some of the others now. And within the Australian indices, financial services have probably performed less well relative to some other sectors. Although recently, thanks to the post-Hayne effect, they're doing a little better. Dividend yields are still higher for the ASX 200 companies relative to the world, excluding Australia, which is interesting. And it's also interesting to note that the amount of net equity raisings has considerably dropped relative to last year. Now, if we look at non-government bonds on issue in Australia, both the financial sector and asset-backed securities are the main issuers of bonds. Now, the RBA gives us a little dashboard of looking at the Australian banks. Bank profits are down a little as net interest margins are being compressed, but the bad and doubtful debt charges are actually lower than they have been. And I would argue that one of the reasons why profits are not lower than shown here is because of the way that the provision has been done recently. Bank profits, though, is down a little relative to previously, so shareholders' returns are perhaps down. And interestingly, the majors are still offering better returns than the other Australian-owned banks. Now, banks, of course, particularly the major banks, net interest margin is still under pressure, and that's a combination of lower volumes, but also the funding overseas, plus the fact that they can offset some of the falls by reducing deposit returns. But at the moment, what's happening is that net interest margins are continuing to slide, and we still think there's more of that to come ahead. The non-banks performing assets are remarkably low at the moment. That's interesting given the 90-day and 30-day default levels that are reported by some of the ratings agencies and our own surveys. But that hasn't yet translated to non-performing assets as yet. Now, this chart shows you the bank's non-performing assets. And it's worth noting that personal lending continues to rise in terms of share of loans. Housing is there too, but still at a very low level. And business is also showing, although a little lower than previously. Now, this shows you the funding composition of the banks in Australia. 60% are deposits, 20% is short-term debt, and around 12% is long-term debt. And there's also equity and securitisation. But the key point here is the banks are highly leveraged because less than 5% of the total assets are actually in equity. So banks are hugely leveraged. And in terms of the capital ratios, you can see that credit unions and building societies are higher than the banks, but all banks are reporting higher levels of capital as APRA turns the screws on the need for capital. But again, I want to make the point that whilst the capital may be higher, the shareholder equity is not growing, and it's still about 5% of the total. So just to reiterate, our banks are highly leveraged. So standing back, what does that actually tell us? Well, firstly, I think it tells us that the economy is looking a little shaky, with GDP potentially coming off a bit. The household sector is clearly under pressure, and that's shown both in terms of lower levels of income and lower levels of consumption in real terms. And whilst employment superficially may be looking quite strong with more than 1 million new jobs, a lot of those jobs are in the services sector. A lot of those jobs are paying quite low wages. And the question is, does a booming services sector really translate into true economic value? It's also, I think, important to reflect on the fact that we are highly leveraged into the resource sector, particularly iron ore, and into China. So we are particularly exposed should China come off the boil. So if you put all this data together, I think you can see that there are a number of challenges ahead. The economy is still growing, but lower. Households are under pressure, and businesses are also potentially under pressure. And actually it's government spending which is trying to do some of the heavy lifting. So my summary report card on the Australian economy is trying hard, but could try harder. I'm Martin North from Digital Finance Analytics. Thanks for watching. I'll talk to you again next time.